Is history repeating itself? Is the economy heading towards another recession? As a society, haven't we learned from our past mistakes and taken measures to avoid crises? It's time to question whether we are prepared to handle another economic downturn. They say regulations help us attain financial stability. But what if the regulations are made in such a way that they benefit only a few people, and then the rest have to live with the consequences?
No losses will be, this is an important point, no losses will be borne by the taxpayers.
The U.S. president reassured us that the money for the bailouts of some of the most important banks would not be levied by the taxpayers. So who is paying for this? We sure know that the FDIC and the Treasury are the ones cleaning this up, but do they have enough to cover such huge losses? Not really, they don't. So then the question arises, where does the money come from? The short answer, it is going to come from you. In the end, American citizens will be responsible for cleaning up the enormous mess that a group of people still under protection caused. Regulations are created to safeguard against negative consequences, money monopolies, and the unscrupulous behavior of bankers. It all sounds great on paper, doesn't it? So why is the biggest economy in the world still grappling with a crippling crisis? As we peel back the layers and examine the root cause of this economic conundrum, it becomes clear that the system is flawed, and a select few are reaping the rewards at the expense of the many. In the wake of the meltdown of banks like Silicon Valley Bank, Signature Bank, and others, shocking revelations arise as the world investigates. Clearly, the 4.5% increase in interest rates didn't work in favor of these banks. Here's some interesting observations we made from this event. It is usually lobbyists, not financial experts, who organize these bailouts. There seems to be a symbiotic relationship between Wall Street and Washington. This event also shows you how the Republican Party and Democrat Party align when it comes to big issues like finances, and how the media will always favor partisanship. The political ramifications of this crisis are definitely something we need to look into.
5 years ago, when Republicans were last in control of the House of Representatives, they used the opportunity to roll back banking regulations put into place after the 2008 financial crisis.
While the Democrats have adopted a blame Trump approach, the Republicans blame the bank for being too woke. Since 2008, major banking regulations have been rolled out to prevent such situations from happening again. The financial crisis of 2008 left the world reeling, prompting a Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 to be put into action. The act gave the CFTC, Commodities Future Trading Commission, more regulatory authority over the colossal swaps market, worth over $400 trillion. The bill, named after its architects, Barney Frank and Senator Chris Dodd, aimed to prevent another catastrophic financial crash by curbing risky investments. Their names may seem insignificant, but their impact on the financial landscape cannot be overstated. Their vision for reform sparked a movement that continues to shape the financial industry to this day. In 2015, Greg Becker, Silicon Valley Bank's president, asked Congress to ease regulations on some banks, including his own. He stated that because of his bank's strong risk management practices, the financial threshold should be lifted to at least $100 billion and as much as $250 billion. Now, who saw that coming? Here's what he said. As a result of taking these steps, we believe we are effectively managing the risk of our business and reasonably planning for possible unfavorable future business scenarios. A couple of months later, SVB added Mary Miller, formerly of the U.S. Treasury Department, to its board of directors, as she had previously helped oversee financial regulatory reforms. Then in 2015, Democratic Congressman Barney Frank, remember him, who was involved in the Dodd-Frank Act, pushed to ease the banking regulations after he was added to the Signature Bank Board of Directors. What a smart move by Signature to get the congressman who participated in creating the regulations to join their board and get them to lobby on their behalf. After he had received more than $1 million as a signature board member, he weakened the rules that he helped enact in the 2008 financial crisis. Clearly, no one saw that as a red flag. In 2018, Donald Trump signed the bill that repealed the Act's regulations for smaller or medium-sized banks. Apparently, the Dodd-Frank Financial Reform Act put extra burdens on small and medium-sized lenders that didn't need to be there. And the bill helped get rid of those burdens and help the economy grow. And it doesn't end there. In 2021, when the Biden administration came in, it had done nothing. The regulations that the Trump administration signed remained unchanged. So does the blame Trump card really work here? Fast forward to 2023, and Biden reassures America that taxpayers won't be paying the bill.
No losses will, and this is an important point, no losses will be borne by the taxpayers.
But that is not true. Unfortunately, the financial burden will fall on us. It all shows us that ultimately, it's the same kind of system yielding the same kind of results. Even if you are someone who dislikes politics, you have to admit there is a kind of flow between administrations. Obama's actions in 2008 contributed to the election of Trump, and this is because the people in power are always trying to be in favor of their financial interest. How do you think political campaigns get funded? The economic superpower, Wall Street, plays a crucial role in deciding who gets to be on the throne. You may have noticed how the government refuses to address this situation as a bailout. It's easy to see why the Biden administration is keen to avoid the B word, given the general dislike toward the enormous bailouts that Wall Street banks received during the 2008 financial crisis. Here's what Andrew Ross Sorkin, a financial columnist for the New York Times and author of Too Big to Fail, the best-selling book about that crisis, has to say about this. It is a bailout, not like 2008, but it is a bailout of the venture capital community, plus their portfolio companies, their investments. That's the depositor base of SVB. It's the right thing to do at the moment, but there will be ramifications and new regulations. VCs should say thank you, he wrote on Twitter. And Susanna Streeter, manager of money and markets at Hargreaves Lansdowne, said that Joe Biden's words of reassurance did little to calm markets as worries raced around that other smaller U.S. banks could become the latest dominoes to fall. The wider banking system will bear the brunt of the bailout of banking customers, as the money will come from fees institutions pay into the Deposit Insurance Fund, Streeter said. But she predicted that the U.S. Treasury will move swiftly to fully guarantee further deposits if more banks turn insolvent. Now, if that happens, it will be harder to argue that the non-bailout bailout will not ultimately fall on the shoulders of U.S. taxpayers. Now, we need to know what the government is going to do to these bankers, because time and time again, they have weaseled themselves out of these types of situations. When you bail people out, they are not really facing any repercussions. They've done this before, and they are going to keep doing it. If there are no penalties, then what is going to happen? Even though the management of the bank was fired and the shareholders wiped out, stricter action should be taken against them. The fact that bonuses were given out on the same day that the bank was seized doesn't seem like they are going to face any consequences. If you're going to run a bank to the ground at the cost of taxpayers' money, you have to pay the cost. This is millions of dollars worth of money. The executives should be held responsible first before anyone else. Another interesting fact is how organized this bank run was. On Thursday morning, a text chain of over 200 founders and funders was sent, wherein it was suggested they take their money out at the same time. If they were concerned about a bank collapse, they would have been focused on saving their money. But instead, it seemed like a group decision to take out their money at the same time. Why is that? As per Ryan Grimm, it is said that in order for the tech economy to survive, it requires low interest rates and quantitative easing. The money that is currently in circulation is generally used for various assets, such as real estate. But ultimately, what funnels it is big tech. There has been a big explosion in the tech sector over the last decade with near zero interest rates. But now that inflation is rising, interest rates are slowly rising as well, which led to the collapse in the first place. It's speculated that the bank run took place as a way of sending a message that they can blow up the economy if interest rates keep rising. So much so that it is said that it can be seen as a threat of contagion by the tech industry. Even though this is purely speculation, let us know your thoughts on it. If it goes the way it did in 2008, the bankers will be fined and they will move on to other places. 15 years later, we hope this doesn't happen again. We don't want to see another bailout. That is why Biden is trying hard not to use the B word. It seems that both political parties favor deregulation, while the media chooses reductive reporting. If so, how will there be a disruption to this systemic problem? Let us know your ideas and thoughts in the comments below. Let us discuss the reforms needed for a change, and if you like the video, don't forget to subscribe to our channel and click on the bell icon so that you don't miss any updates. See you in the next one.